Good morning, it's Jeffrey Cohen, U.S. Advanced Computing Infrastructures, Inc., also known as Chicago Quantum, here to talk about how the markets are risk-off, and we found what we thought was the perfect speculative bet. We were very excited about it. We were ready to move some significant money into that bet. It was 2 stocks. It was supposed to beat the S&P 500. And then we did some due diligence, and we dodged a bullet, we believe. And so we have since rerun the model, made adjustments to the parameters, and we will not be buying that trade. But I wanted to share with you what happened because it's interesting. I'm looking at different screens here. It's just so interesting. You know, market opens in about 20 minutes. I'm going to be quick. So we published a blog post. We sent out an email saying that the market is risk off. And the reason is that the risk-free rate of return is 4.625. And the expected return to U.S. stock risk assets, think S&P 500, think NASDAQ, think Russell, that these are not the best bet. That the return for the year will be 7% starting now with a 1.57% dividend yield. Now that's not bad, earn 7% plus get a dividend. But when you can earn 4.625 risk-free short-term money, it makes the stock market a lot less attractive. And so I want to share some facts, right? So we recently added foreign companies back to our model. It's about 500 of them. These are companies that they operate in foreign countries. They're headquartered in foreign countries, but they're listed here in the U.S. So some of those, at least I feel, can be manipulated. Some of those are your crazy, weird, moving stock situations, much more so than a U.S. Incorporated firm. I saw this last year. I saw this 2 years ago, and it's just interesting, right? So that was one thing. So we didn't want to remove them anymore. So we wanted to bring them back. The second is we got almost 3,100 stocks in our run. That takes a really long time. That is a very large run. And if you held all 3,076 stocks evenly, your expected return would be 9.12. So that would be a return of like 7.5% plus dividend yield. And the variance is 3.43 times 10 to the negative 4, which is elevated. So it's an elevated variance. It's an elevated return. And so in conclusion, what happened, right? And then I'll tell the story. So what happened was the best individual assets that we find are the actual exchange-traded funds that hold multiple stocks and bonds. So the best risk-free return is actually the ETFs that are managed to give you a risk-adjusted return. Okay, that's not that interesting, except that when stocks are more risky, it is not unusual to find individual stocks that are better. Not the case today. Today, stock picking is not your friend. Number 2, the best Chicago Quantum Net Score Long portfolio held 49 equities. And the edge is tiny. It's 1/5 the normal edge of our model. So it may not even be worth it. So we ran it again during the Superbowl. Actually, we ran it for hours and hours. I ran a much deeper last analysis. And here's what I found. We ran very deep. Best portfolio was still 6.4 times 10 to the negative 5, which is that tiny 1/5 edge. But we got it down to 45 stocks. So 45 stocks is the best after running another like 2 hours, 3 hours of analysis. Okay. 45 stocks. That's tricky. So what should you do if you are a regular investor? Stay conservative this week. Buy the risk-free assets. Earn the dividend yield. Earn the interest rate. Relax. It's okay. You don't need to jump in front of the train. The return's not high enough. Maybe just take the money and buy some bonds. Relax. That's what it says. It's crazy. So I'll tell you what originally the model was telling us. And I'm going to show this to you, and it's going to blow your head off, right? I know you guys don't like downtime, quiet time, but it's probably better than me just talking. So what I'm doing is I'm looking for the original run. I don't even know that I saved it. I probably did. So I'm finding it. I'm downloading it now so that I can share with you from the original source what I found. No, I never saved it. So that is very interesting. So the speculative trade was a very dangerous trade. It was I know you can't read that. It was those two stocks. So Zim is an Israeli shipping company that paid an exceptionally large dividend last year. TNA is a 3x long small cap ETF. This should have a beta of 3.0 and should go up when markets go up. So the thought was that these two stocks held together would do it. But what we found was that Zim has something like 122% dividend yield, which means it gets 122% boost in our model. So that's not okay. Not sustainable. And not reasonable. So that's what happened. Don't do this, right? This was the trade of the day that we thought we got very excited about. And so we can take a look at ZIM and see how it does. But net, this was the speculative trade. And this was the trade that we did not do. And then ultimately, the trade of the day is 45 stocks held evenly for a tiny edge, which means effectively don't bother. So what do we see? What do we know about Zim? Well, the first thing, if we just look at a daily chart, is that it used to be quite the high flyer. Look at that. It was 20 bucks, 80 bucks, 20 bucks. So somehow it went up when the cost of shipping went up. Up, down. Dividend, dividend. So a $2 dividend, $2.50 dividend, $17 dividend, $2.85, $4.75, $2.95. So it looks like they just derive dividends based on how much money they earned. And I mean, it's great if you can get a $3 dividend every 3 months, right? That's 12 bucks on 20. You run with it. But you can see it's down in pre-market. It's down 3.25%. And so, I don't know. This isn't where I put all of my eggs. This is not the basket for my eggs. It's just interesting. And so, the other one, TNA. Let's take a look. So what happens is if you run a model and you just decide you're gonna buy it without thinking, what's going to happen is you can end up in a really odd place. So if we look at TNA, you can see it was up in the 60s earlier, a year ago. Looks like it's down, it's up, it's down. It almost looks like an inverted head and shoulders. If you look at it this way, it's just down. Looks like it just keeps pounding lower, right? Because if the market drops, it's going to drop. So it's trying to make highs at around 40, and it just is it's coming back down. Look at that. It hit 45 in like a couple of days, right? In a week. And then it came back down. So what the model had said was, look, you could hold 45 stocks or you could hold Zim and TNA. And I got to tell you, I just didn't feel it. I wasn't feeling it. It didn't feel right to me. You know, this type of craziness just didn't work. And so even if we look at this over a 1 year period to see, does it make sense? It might, right? Because if you look at the zigs and the zags, these guys are zigging and zagging away from each other. That's a very attractive thing. Because when one is going down, the other one maybe is going up. And that's helpful to offset risk. But these are tricky. This is very risky. So the question is, at what point do you actually make this trade? Yeah, maybe it drops another 5-10% and then you stick some money in it. Maybe you buy it a little lower. But I just find it interesting because TNA is really just a derivative of the S&P 500. And Zim is really a play on transport. Ships. They don't even own most of the ships. They just have a network of ships, right? And so they do the shipping, they arrange the shipping. Probably a lot like Maersk and others. It's just interesting they pay out dividends so aggressively. It's nice. Instead of just giving it to management. So I want to thank you for watching. We dodged a bullet by checking the dividends. $17 dividend on March 22nd made this stock a crazy, crazy play in our model. And this is the challenge with foreign stocks, is you get weird stuff like this. But if we're going to put it in, it just means we have to lower the sensitivity to dividends. And we did that. And now we're running about 3,100 stocks a night. We're picking the best, we're picking the worst. And we're doing it for you, our listeners, our viewers. And if you like the video, you know, our YouTube handle is I am Jeffrey Cohen. Go ahead and subscribe. Maybe share the link with others. Let them know you like the video. Drop a comment. Love that. Just drop a comment right below. And good luck in the markets. I want you to take care and be safe out there. Bye-bye.